Hello. This morning I thought I would try something different than I normally do, and that's show a sort of remedial review of how my trading system works. And so I'll just go over a bunch of graphics that I've accumulated over the years in trying to explain this system. And seeing it in a graphical form might help understand my method a little bit better than just showing it demonstrated in live trading. But after I show the graphics here, I'll go over the system working as it would in a live market. And so basically what I'm showing here is how I got started trading. And this was in the days before the computers, and when I would just call in an order to the broker. And what I did was sort of what the old school traders used to do, and that was compile a list of the daily high, low, open, and close prices. Now this is from a 1 minute chart, but you could use these same prices for daily charts, for daily bars. And that's how I used to trade. It wasn't by the minute, it was by each individual day for long-term position trades. And so what you'd do is you'd get a newspaper like the Investor's Business Daily and get the list of the high, low, and open and close price for the day. And then you'd compile a list over the weeks. And this is a process known as ringing highs and lows. And I don't really pay attention to the open and close columns, but I'm interested in the high and low columns. And this is the original, an old school method that the original traders used to use when they were watching ticker tape displays or readouts down at the brokerage houses. And you just get a list of these numbers, or you could call the broker at the end of the day and just get where the current price is. And so basically how this works is you have a column of highs and then you have a column of lows. And so what you do is pick the highest high that's higher than the previous high and the following high, and you'd circle that, and that would be your minor level high. And you do the same thing with the lowest low and the low columns. So a low that's lower than the previous low, like this is 5371.25, that's lower than the 5373.75, and it's lower than the following low, which is 5372.25. So you do this for each column. The highest high here would be 5384.75. It's higher than the previous low, higher than the following low. And you just alternate back and forth between columns. And so you'll get this staggering pattern. And sometimes you get the high and a low occurring on the same bar. And the other instance is when you won't have a high or a low that falls in between the corresponding. For example, this is a high, a minor high, and this is a minor low. But this would be considered a phantom high, in that it's actually it's easier to show by graphics, but as you can see, 5369.25 is higher than the lows here, but you don't get a high price between these two lows, or higher price than these two lows, is what I'm trying to say there. And so that's what's known as a phantom bar. And on the charts, I call these inside bars, and I'll show what they are. I'll demonstrate what they are. But I know it's kind of difficult to explain here quickly with a graphic. But what I then do So now I've got the minor highs and lows circled. These are the minor swings. I circle the of the minor swings. You take the lowest low between the two circled minor swings, and that'll give you your intermediate point, your intermediate swing. And you do the same thing with the highs on the intermediate highs on the high column. And this method dates back to the earliest traders before they even had charts, and they'd make their own charts by hand. And so it's kind of a lost art today. You know, people don't have forgotten how to do this, and so this is kind of really valuable information just to know the structure of how charts are created. And you won't ever really do this, but this is just to show the principle behind trading a chart, or behind seeing the highs and lows on a chart. And here I've just demonstrated by marking an orange dot between these same highs. On some I missed a couple because visually I don't think they're all that important. That's this would be a minor dot that I missed right here, but you can see how they form the fractal patterns that I'm always talking about. Originally I called them hook patterns or swings. Traders have a lot of different names for them, but what I'm doing here is I'm marking the minor highs and lows with orange dots. And this is the same thing that traders used to do without looking at charts. They do this by hand, just by a column of highs and lows. And if you were to connect these dots, you can see how they form minor swings. And I think I missed a swing right here. I could have shown that, and that would have been a 1, 2, 3 pattern for a minor swing. So these are now tradable swings. And to show how the intermediate swings overlay on top of that, it gets kind of busy here, but I've drawn a orange line depicting the minor points. So I call these a minor, I mean the intermediate points here. I call these minor points, like this would be P1, P2, P3, and the intermediate points I would label I1, I2, I3. Just I don't do that much anymore because I think it's more important to, rather than look at a number, you're looking at the just the relationship. And what I do these days to instantly see the intermediate swings, which I've drawn here in orange on this is the 1 minute chart. I use the 5 minute chart to visualize where these intermediate swings are at a glance. And the whole idea between this method, if you notice, these green lines are in the uptrend lines, and the red lines are the minor retracement swings or pullbacks. And so the idea is that you'd always want to trade the intermediate, or the minor swings. In this case, since it's a small uptrend here, these minor swings would be considered the action swings in the trend direction. So these are action swings, and these are reaction swings, the red. And so the objective is to trade the action swings occurring on the minor level that are aligned with the action swings occurring on the intermediate level. So for example, this would be a good example right here. Trading the breakout of that this 1, 2, 3 point here, and this crossover would result in a good 3-point trade right there. So you'd wait for the minor reaction to occur here. You wouldn't want to trade the the minor swing that was in the opposite direction of the intermediate action swing. So you sit that trade out, right? You sit that retracement swing out, and you wait for it to start moving back into the trend direction on the intermediate swing here, which is the other green line. So as you can see, it results in a real good trade right there at this indicator, which this blue indicator line is the 80 MA line, which stands for exponential moving average. So entering the market right here, it would result in a nice trade, uptrend trade. And so here we have another retracement swing. We know we don't want to trade that. But the trick here would be to identify this point as part of an intermediate retracement. And the way to do that is by noting the angle of the 80 MA line, which I'll get into later. But you can see this is the intermediate retracement swing, which is not going to be as profitable as the trading the intermediate action swing direction. So generally, if the volatility is kind of low, you wouldn't want to trade this retracement swing that's counter trend to the intermediate action swing. So right over here, we once again enter the market, and we've got a nice trade to the upside. Over here, we're switching to a downtrend, and we can see it makes an intermediate 1, 2, 3 pattern, and then a crossover, and that's our downtrend signal, and it's aligned with the new intermediate action swing in the new trend direction. We don't know it's an action swing yet until it breaks below this what I call the number 2 point, the intermediate number 2 point or number 3 point. If we're looking at a reversal, that would be a number 2 point. I'll get into all that if it sounds kind of confusing right now, but that's how I organize my the pattern of my trades. So here's another example of that. I've marked all the intermediate points. This chart, is an example of high volatility. Since each grid line is set at one point, this is a really it enables you to see volatility at advance when you set the grid lines to a fixed point. For example, this is fairly low volatility right here, and you can see the difference when you get a high volatility day. It's almost turns the chart to looking gray, and this was around the time of Trump's nomination. So the market was really volatile then, and we've had some days like this this year. Not too long ago, we've had some really high volatility days, but you can see the system is still working just the same, and we can still mark the minor points right here, as you would look at on a column. This, for example, would be higher high than the previous high and the following high. This would be a lower low than the previous low and the following low, and so these would be the minor swings. So if we connect the dots here, we get the minor swing patterns, and this is what we're trading on the 1 minute chart. And if we can, we're trying to align these action swings. In this case, since this first part is a downtrend, the action swings would be these red swings here into the trend direction. And we want to make sure that these action swings, the minor action swings, are aligned with the intermediate action swings. And so here would be the intermediate swings, which are I'll show how these look on a 5 minute chart. And the 5 minute chart makes it very easy to see where these intermediate level swings are that I've marked in orange. And this is the 1 minute chart, but you can see that you can see where the intermediate level swings are occurring on the 1 minute chart, which would look like the minor swings occurring on the 5 minute chart. I guess that's the best way to explain that. But I use the 5 minute chart on the left side normally in my trading, so I see at a glance, because since I'm day trading, I don't have time to really plot everything out. I need to see things instantly, so that's what the 5 minute chart allows me to do. See the intermediate swings. What I'm showing here is how I came across the idea for my indicators. And what I noticed is that if you look at these blue and magenta indicators, what they basically are sine wave cycles that are occurring at different periods or periodicities in the market. And so the areas where they intersect, I found equate or fine-tuned to either trend changes or their resumptions back into the trend direction. So those are significant points where these lines intersect. You can really see it here as you can see that when the market's trending strongly, you don't want to take the counter trend or the crossover swings in the counter trend, even though it would work here if you're using a smaller target. So just remember that rule of thumb, that if it's trending strongly, avoid taking the crossover, the ADMA crossovers that look like they're moving opposite to the intermediate trend. You're always going to do well to trade in the intermediate trend direction, especially in a strong trend. But in a day where the market is more sideways, you can see how the crossovers tend to work in both, or they tend to work better in both directions here. So the crossover here would work for a 3-point trade. Still not working too well on this one, but here again you're trading counter trend to the intermediate trend direction. So even if it's a relatively shallow trend, it's still a good idea to pay attention to what the intermediate swings are doing. So always try to trade with the intermediate action swings. But the relationship I noticed with these indicators was like a sine wave. And here's the idea would be to take as the sine wave cycles intersect, this would be the equivalent to the ADMA line intersecting with the 14 simple moving average line, which acts as our baseline. And in the upward part of the cycle, you'd want to be long, and in the downward cycle of the sine wave, you'd want to be short. So always pay attention what this cycle is doing on the 1 minute chart. You also want to pay attention to what it's doing on the 5 minute chart, but the 1 minute chart is where you're entering the trades, so it's very important to know what phase of the cycle you're in. For example, if you're wanting to go short, you want to be sure it's at this cycle here, and it's not up near the Bollinger Band line, and not angling it back inward toward the towards the SMA line, because that's a sign you're in the upward cycle now, so you'd want to be long here. So anytime you have that line bending back inward to your SMA line, you don't want to be trading that. So that'll keep you out of a lot of bad trades just following the cycle. This is it's one of the best systems I've ever heard of, but I don't think anybody else is doing it, or that I know of. So I think it's kind of a unique discovery for me. In reality, the cycle tends to look like a DNA strand here. And so if you look at this DNA, you're trying to trade, you're taking the trade in the down direction here, and as the ADMA line crosses back over, you're taking the trade in the up direction here. You're watching the sine wave cycle as it starts to come down. You know you don't want to be long here, so you take the short trade here. And this is all in context with what it's doing on the 5-minute chart in the intermediate trend. So you always give deference to that. So here I just I'm illustrating more graphically what I'm looking at. I'm interested in these intersecting areas, and this is the direction I'm interested in trading. So up cycle as it's angling outward, and the down cycle we want to be a short trader as it's angling inward. So it's kind of as simple as that, but with the caveat always that you're trading in the intermediate trend direction. So if this is a strong trending up move, you don't want to ignore the down cycle of the sine wave here, and that'll keep you out of a lot of bad trades where you wouldn't hit your target otherwise. Here I'm showing the cycle in relationship with the price bars as it typically occurs. So as these as you're heading into the downtrend here, a lot of times you can get into the trade as it crosses the little bit before the crossover in these angled areas right before the crossover. So here would be a good short trade. Here's the crossover. Here would be a good long trade, good short trade, and then long trade here. And so that's the relationship with the price bars thrown in. Here I'm just showing the entry points, which would be ideal for the crossovers. The crossovers are such excellent trades for new traders because they're easy to spot. You know, you don't need a whole lot of skill to spot these kind of DNA strand sine wave cycles where they intersect. You can easily spot those as a new trader. Here's a typical the way a market moves in a as the market starts getting sideways. You're in what's called a trading range, and what I'm looking here is these outer gray lines. These would be the Bollinger Band lines, and this would be the lower Bollinger Band here on the bottom, and the upper Bollinger Band on the top, and it would be equivalent to where the resistance of the market is and the support line. Support line and resistance aren't marked, but the Bollinger Band gives you a good indication of where those areas are. And so in a sideways market, you want to trade the bounce off support and the bounce off the resistance area. The support acts like a floor and the resistance acts like a ceiling. And the other area that's trading within the range if you have enough room either side of the ADMA line. You can trade within the range, but also trading the breakouts of the range are very lucrative trades. Sometimes you'll get a false breakout, but in those cases you'll often you'll have a false breakout and then it'll head to the other side of the range. But anytime you can get into a breakout trade, they're usually going to run a long ways, so that those are fairly lucrative trades. And you can see in the range what I do, since it's usually going to give you one trade each side of the ADMA line, or each side of the crossover, as a general rule. So you take one trade here at the crossover, take one trade here, take one trade here, and so you're mainly concerned with trading the crossovers. You aren't trading the hook patterns like you were with like I showed with the trending markets. And that's kind of the normal pattern of a trading range. Here would be kind of more typical of a trend, and in this case you can spot the trends because the Bollinger Band lines are generally moving up, and the ADMA line is moving up, and it's also expanding outward from the 14 SMA line. And so again, these areas after the crossover, which are right in the corners here, are the best, the highest probability points for taking a trade. So all you have to do would be to watch for the crossover and take the first trade after the crossover occurs on the first bar, and usually you're going to get a very good trade at that point. As the trend wears on, it gets a little bit more. The ADMA line will tend to start to parallel, and then the SMA line, and then start to turn inward as it's about to go through a trend change. And sometimes you'll get a long pullback, like right up here at the upper Bollinger Band. There's a long pullback all the way to the ADMA line. On those, I want to see it first cross over the ADMA line, then I want to see a trade back up through it. I might even wait till the third bar just to make sure I've got good momentum back upward, because this could also be a trend change sign. So you want to make sure that ADMA line is always angling upward before you in the direction you want to trade before you take the trade. As a good rule of thumb there. This is a typical minor swing pattern, and I'm just kind of showing how the intermediate swings overlay the minor swings in a trend, and that's kind of redundant. I was just over that. Here are typical reversal patterns. I call these 1, 2, 3 highs, and then if it were to make the same patterns going upward, it would be the 1, 2, 3 low formations, or some people call them 1, 2, 3 tops and 1, 2, 3 bottom formations. But these are the different ways that I've found in which they could form. Sometimes you'll have the 1, 2, 3 form before the crossover, before the ADMA line, and before the crossover is made, in which case I like to trade where the crossover occurs in conjunction with the breakout of the number 2 point. Ideally, what you're trying to do is trade the breakout of that number 2 point, and if they occur simultaneously, the ADMA crossover and the breakout, you've got the best of all worlds right there. In scenario B, we have the 1, 2, 3 occur after the crossover is made, and on some of these, if the volatility is good enough, you can go short right at the 14, the magenta color 14 simple moving average line. But the more conservative approach would be just to wait for the 1, 2, 3 to occur here, and then trade as close as possible to the blue ADMA line. The other scenario is where the number 2 point occurs before the crossover, but below the ADMA line in a downtrend 1, 2, 3 top formation, and the opposite would be true in 1, 2, 3 bottom formation, where number 2 point would form above the ADMA. In that case, you'd want to wait for the number 3 point to form and make sure it's after this point, after this 1, 2, 3 formation is solidly formed, you want to make sure it's definitely heading back through the ADMA line and enter the trade right there at the ADMA, or even the breakout of the number 2 point, but preferably as close to that ADMA line as possible. So those are the three main scenarios that I've found for trend reversal formations to occur, combined with the crossover indicator. Another example of the trade model, typically you'll have a 1, 2, 3 trend change formation, 1, 2, 3 bottom in this case, and then you'll form a series of what I used to call hooks or fractals forming the trend. Usually there's about 3 of these in a trend, but a trend can have many fractals, or typically is more than 3 or 4 before you get a reversal. Then you'll have 1, 2, 3 top, a 1, 2, 3 top formation, and you trade the breakout of the hook, or the number 2 point here, and so that's a significant formation. If it falls below the previous, like if it were to fall below the previous number 3 points here, that would be an indication of a trend reversal. And so what was previous in a number 3 point here becomes the new number 2 point in a new trend direction. So a trade below that is usually a very valid trade in the new trend direction. That's a very common trend change formation. It's probably one of the first things that most traders learn, is the 1, 2, 3 and 1, 2, 3, 1, 2, 3 top and 1, 2, 3 bottom formations. I just show another example of that with the trade out of the number 2 point, trade the breakout of the number 2 point and the 1, 2, 3 bottom, and then on the hooks, we want to trade 25% into the new direction, because this is what I used to do if I was trading the daily market. As a day trader, I just want to trade as close as possible to the ADMA line, and preferably as it's moving in the intended trade direction. I used to choose a 25% number because that showed at that point you saw it was good momentum into the trend direction, and it confirmed that the number 3 point was valid. So these number 3 points I will refer to usually as P3 points. P meaning just the minor swing. So here would be an example of how it actually appears on a bar chart. You want to trade as it's crossing back over the ADMA line, and this would be a typical steep trend formation. A lot of times you'll get these forming off the line if the trend is really steep, and so it makes it difficult to enter because you won't get it right on the ADMA line, your entry point. And most of these entry points I'll enter at the open that was right where the low of the last bar, the close of the last bar left off. So the open here would be a good trend entry point, or a trade entry point. Or if, at the crossover as it comes back above the ADMA line. Anywhere in this vicinity, and you're usually in a high odds trade, as long as this line is angling outward from the SMA line. So these are very high probability trades right there if you have that picture. Here's an example of what I was talking about with a phantom 3 point. You get a valid number 2 point, but you can see it doesn't really form a lower low than the previous low, and I call these are usually referred to as phantom number 3s. But I usually just call them inside bars, and usually these are valid in very strong trends, but I wouldn't want to try to trade them as they occur in a trading range. So if the trend is really strong, you can sometimes get into a trade from watching for the number 2 point to be made, and then getting into the trade recognizing that it's a inside bar and it's not going to form a number 3 point, but as the momentum occurs back into the trade direction, you can sometimes get into these at the previous open and close price, or you can get into them at a breakout of the high, depending on how close they are to the ADMA line, and those will usually produce pretty good trades. Here's just another example of the calculations I used to use for determining the entry point. That's a lot of that's just showing the mathematical relationships between these P2, P3, and P1 points. But of course, in day trading, you don't have time for that. But I just show that to show the relationship we're trying to look for here as it moves back into the trend direction. And usually that amounts to about 25% of the previous move from P1 to P2. You want 25% of that from P3, and that's usually a valid entry point. But if you're trading each by the day, you have time to do that kind of math. But when you're day trading by the minute, usually you don't have time for that. So you're just using the ADMA line as your indicator, your entry price, after the P3 point is made, or sometimes on the same bar that the P3 point is made. Here's an example of a long type of pullback that sometimes these can indicate trend reversals, because that might be a 1, 2, 3 top formation, and you're really judging by how the ADMA is angling in towards the 14 SMA line for these. If you get a break below the low, and we're up here towards the upper Bollinger Band, you get a break below the previous low, and it's really hugging that upper Bollinger Band. Don't be in a hurry to trade that, because that could be a trend reversal. So what I like to see in that case is for it to come down below the ADMA line, and I won't get into that trade long in the previous direction until I see a good amount of movement back up through the ADMA line. So I'll try to show an example of these types of trades. But they're a lot of times they're very difficult to judge because they take a lot of patience. You have to wait for that number 3 point form down here. All the time you're suspicious that it might be a trend change, and only when it starts showing momentum back up into the trend direction do you enter the trade. That's one of the subtleties that I was talking about. On here I show a whole different series of different types of these formations. This would be a typical long trade right over here in this first one at example A, and this will be a type 3 trend reversal formation, 1, 2, 3. The number 2 point, the 1, 2, 3 high, occurs after the crossover is made. In that case, you could, if the volatility is good enough, like it is here, the volatility is pretty good. If you're trading, let's say, a 3.5 point target, so you've got enough volatility distance between the crossover and the lower Bollinger Band right here, that you know you're going to hit a 3 or 5 point target there. So that volatility is pretty good. So I can make a judgment call and enter the trade right at the crossover, or when that price bar crosses the 14 SMA line, the magenta line here. And then we wait for the pullback make the number 3 point. And since it's a fairly long pullback, you want to see momentum down into the trend direction. At the same time, the 8 EMA line is angling out from the 14 SMA line. So that'd be a good example of that type of entry after the P3 point is made. And then here we have at the D position here, we have entry, same bar entry, in which case I like to see, it's not really a long pullback, but I'd like to see it touch the 8 EMA line and then pull back through the previous close, and that would be a same bar entry. Those are more difficult to get into and they take a little practice in seeing, but it's just being aware of where that 8 EMA line is, and you can, as long as you're trading close to that line, you're gonna, and the line is angling outward or parallel to the SMA line, your odds are your trade's going to be pretty good if you've got a target adjusted to the volatility that you're trading. Here was just a simpler example that I was just trying to show the concept of trading in a trend, which I've kind of already been over, but this is just a very simple diagram to just show the concept here. Generally, how the market moves is a series of trading ranges, and then you've got trends in between the trading ranges. Sometimes you have trends inside the trading ranges, but this is kind of the example. It's like one of those hamster cages, those hamster habitats you had, where you'd have a little room, which is like the trading range, and then you'd have the trend in between them. And here's how I would set up my bracket entry for the trades. The bracket orders allow automatic orders to be set. So that, let's say in this case, I'd be going long at this market entry point, and the software would automatically set the target, the sell limit order, and the sell stop loss. That's for the buy side if I'm going long. Now if I'm going short, it'll do the opposite. So here would be my market entry price, and the software automatically sets a buy stop and a buy limit. One order is below the market, and the other is above the market entry point. And that's why they call them bracket trades, because they bracket your entry point. And I'll show how to set those up. This is just an example of how the minor level swings compare with what you're seeing on the 5-minute chart in terms of the intermediate swings. And you can see this whole section here would be equal to one swing here on the 5-minute chart. So everything from here to here on the 1-minute chart, from around 6:30 to 6:58, is just this distance right here, from about 6:30 to 6:58 on the 5-minute chart. So you can see where the intermediate swings are occurring, especially the crossover point. You would know that you want to trade the minor swings that are aligned with the direction it's moving on the 5-minute chart. So these are the action swings in the 5-minute chart, which are clearly down. So you know to take the swings on the minor level chart, the 1-minute chart, after the crossover is going to be a good trade, because that's aligned with your what's happening on the intermediate chart, and or the 5-minute chart. So that's the way I use the 5-minute chart to see the intermediate level swings, because you really don't have time to figure this out when you're day trading. Here's just another example of fairly high volatility market. You can tell the volatility at a glance by how far apart the grid lines are. So this is after a 1, 2, 3 bottom's been made, and you start seeing the Bollinger Bands bend outward, and the ADMA line start moving upward like a alligator mouth opening, and that's your entry signal. And these are fairly obvious, and you can see here we've got a fairly good sized pullback to the ADMA line, and so I want to see momentum coming back up. In this case, I think you'd be justified in trading the break out of the high of the previous bar, or at the open as it comes back. I always want to make sure that it's heading the right direction first, so I'd wait for it to first touch the ADMA line, then come back through the open, which is aligned with the previous close of the previous bar, and that'll give you a good entry point into the next swing up. And you see how here at this point the ADMA is starting to turn downward. I see a symbol like that after a good, you see how the break below the low here is up near the upper Bollinger Band, and that's a possible trend change signal. And we can see what's happening here on the 5-minute chart. It's reversing back through the upper Bollinger Band here. So that's telling me I don't want to be long. I want to wait for that retracement to at least come back to the 5-minute ADMA line, which will probably drop right through the 1-minute ADMA line. So what that tells me at least is that I don't want to be a long trader, and I don't want to be a short trader until I've got a crossover confirmed either. So it's important. It's just as important sometimes to see what not to trade as what to trade. And this tells you where not to trade in this retracement pattern right here. Wait till the number 3 forms first, and wait till it has momentum going back into the intended trade direction before you enter that. So that's basically what I wanted to show with that, and